Good to be here again. I'm Rajeev, partner at Orias, an early stage VC fund. We have invested in about 120 startups. We have about 7 or 8 unicorns. We have with us Mike Alfred of Alpine to share his macro outlook and the value opportunities that he's spotting in this volatile market. So Mike is a Stanford alum, prolific investor in public and private companies, and prides himself on being a value-oriented investor. Mike can speak to a whole range of asset classes from venture, startups, fintech, crypto, Bitcoin, stocks, and public markets. That's a whole range. He's a 2x software founding CEO, 2 successful exits, and a razor-sharp understanding of traditional markets with a deep understanding of Bitcoin. So these are 2 very non-linear ecosystems that you have a very clear viewpoint on, Mike. So we are really looking forward to it.
Thanks, Rajeev, and thanks for having me. We just talked before you started recording, and I've taken one of the most indirect paths that you could possibly take to get exactly where I am right now. And of course, that happened in part because I didn't know exactly where I wanted to end up 20 years ago. Exactly. It was about 20 years ago when I graduated from Stanford this month. And if you'd asked me then what I'd want to be, I would have said something like what I do now. But the path to have achieved that over the last 20 years was completely unclear. That going to Stanford does not help answer the question of who you are and what you should be in the future. And so, it's been an interesting journey. When I was at Stanford in the late 90s, the tech bubble was blowing and eventually burst. And I was investing in my dorm room. I'd wake up at 5:30 in the morning and I would trade internet stocks, Inktomi, Infospace, CMGI, even Webvan at one point, right? Like go down the list. There was JDS Uniphase and Cisco, and right, these were big important companies.
Of course,
at
Cisco.
the time.
It was the number 1 market cap on the planet for a while, wasn't it? Cisco.
Yeah, and it's funny because both Cisco and Microsoft hit all-time highs, and then for 15, 20 years, even though their businesses continued to grow, their stocks didn't hit new all-time highs. And that's really a good lesson, something I picked up from the late 90s, trading in my Stanford dorm room, making a lot of money, losing a lot of money, is that a good company is different than a good investment, because a good investment also timing matters, valuation matters, right? Objective matters. And so just saying, hey, that's a good company, go buy it. And if you told someone to buy Japanese stocks in the late 80s, right, they crashed. And to no fault of your own, if you might have bought a good Japanese company, but it turns out it was overvalued, right? The same way that the internet was not systemically overvalued collectively in 2000. Basically, our views about the future in 2000 when I was at Stanford, that Google would be an important company, right? Or when Facebook first came out, that it might be an important company, right? Or Microsoft, or any of these companies might continue to play a bigger and bigger role, Apple, et cetera. That was a pretty contrarian view in 2000, between 2000 and 2002. But the people who were really excited about it bid up all of the internet stocks, right? So every .com traded at 500 times sales, right? Every .com was able to go public even if they didn't have a business. And so the nuance is that a market can be a wonderful market, right? Investing in the internet over the last 20 years is one of the best investment trajectories in the history of the planet, right? So if you were an internet investor in 2000 to 2002 and you were buying internet companies, you were buying internet infrastructure like Equinix, data centers, right, to support the growth of the bandwidth, the chips. If you're buying NVIDIA, I remember NVIDIA's been around for a long time. For many, many years, it never traded much above $5, split adjusted, whatever it is now, right? But it was a great time to invest in the internet, but 95% of the companies you could have bought in 2000 went to zero, right? And so you have to bifurcate your brain, and you have to understand both that the internet is one of the most important things that's going to change the entire planet over the next 20 years, but also investing in 95% of internet companies right now is a money-losing proposition. So fast forward to today, right? And I haven't even covered my background, but this is the biggest thesis that I can think of to share with this group. I believe we're right at the cusp of the same point as 2000, 2002 in the internet for Bitcoin, right? So I think 2022, 2023 is the bottoming after what we basically had our great financial crisis moment, right? Celsius, BlockFi, FTX, Voyager, right? Globally, you look at all these companies that basically imploded. It turns out that they weren't well run. It turns out they were over levered. Sounds a lot like 2007, 2008, right? Lehman, Bear, Washington Mutual, right? People like to claim that the traditional financial system is more stable than Bitcoin. But the reality is that the traditional financial system has just as many issues across time. But we've just been through that kind of moment in the Bitcoin ecosystem. But I see 20 years of growth ahead, just like I saw 20 years of growth for the internet in 2000. So again, to bring that analogy to the present, what that means is that 95% of the ideas in crypto are absolute garbage. And 95% of the things you can invest in will go to zero. That's true. But also, if you understand Bitcoin fully and you invest in the appropriate parts of the infrastructure stack where you're least likely to lose money and you pay the right price for those assets, I believe that'll be one of the best IRRs over the next 2 decades. And that's, again, a deeply contrarian view at the moment. So, going back to, my background, I graduated from Stanford. I was a financial advisor for a brief period of time. I started a company called Brightscope, which gathered U.S. retirement plan data and published it on the internet, and built that up to over 10 million in revenue. Sold it to private equity. Did a crypto data startup selling data to the largest crypto hedge funds in the world, like Paradigm and Polychain and Multicoin, et cetera. These are great firms in the space, but it just wasn't a big enough market, and so I was able to sell that company to NYDIG in 2021. Actually, it was 2020 November. And I ran strategy and M&A for them, and that's how I got into the Bitcoin mining space. We invested $50 million in one miner. I led a Series A into one of the most important mining pool operators. I also did a full acquisition of a mining equipment lender in Canada. All of those kind of reshaped the business for them towards that space. And in the process, I met all the teams, right? I talked to the top 40 or 50 teams of public and private miners globally. And so when I left, I got a call from Iris Energy, guys there, two brothers, Dan and Will Roberts, and they said, "Hey, Mike, we really liked working with you when you were at NYDIG. What do you think about joining our board? We're thinking about going public on NASDAQ next month." And so I joined the board October of, I believe that was 21. We went public in November 2021, near the peak of the Bitcoin cycle, the last Bitcoin cycle. And so it's been a tough road, right? We went public at 28, stock bottomed at near $1. I was recommending it strongly over the last 6 to 9 months. Obviously, I'm on the board, so I'm conflicted in a sense, but I also believe in the company and I have exposure, right, to almost 1 million shares at this point. So, it's a company that I believe in. But again, after the 80-90% drawdown we just had, it feels like 2002 internet. It feels like a time where everybody's negative at the exact wrong time, right? And I remember that vividly. For the right reasons, people had soured on internet stocks in 2002. I was at Stanford and nobody wanted to talk about internet stocks for 2 or 3 years. And that was quietly the time to be buying Amazon, right? That was quietly the time to be buying Yahoo or Equinix or any of these companies that ended up being an important part of the internet story looking forward. So I think we're at a similar point. So my fund, Alpine Fox, only has one outside LP. It's basically just my money and one other wealthy US family. And the goal is to build something similar to what Carl Icahn and Warren Buffett and folks like that, Paul Singer, built over the last 20, 30, 40, 50 years. A long-term value-oriented investment partnership. The goal is to own the great businesses when they trade at a good price. But we're not going to skew new ideas and technology, right? I think one of the problems with traditional value investors is they tend to not understand technology at all. And then when they finally understand it, it's kind of late, right? So for example, I went to the Warren Buffett, Berkshire Hathaway meeting, shareholder meeting in 2010, 13 years ago. And I was deep into Google, Apple, Facebook, Amazon, right? All these companies. So Facebook didn't go public till later, but I was deep into the ones that were public. At that point, I really believed tech was an important part of the next 10, 15 years. And Warren Buffett didn't understand any of those companies at that time. Fast forward today, now he's one of the largest shareholders in Apple. There's nothing wrong with that. It's okay to be late sometimes, but I don't want to be systemically and systematically late all the time in a category that I think drives the future. Essentially, you're not going to be a viable business in 10, 15, 20 years without technology, even if you're a manufacturing business, even if your product is primarily a physical asset. You still need to leverage technology to be competitive. And so this idea that value investing can just be energy companies and railroads and soda companies and insurance companies, like that's a 1950s to 1980s kind of paradigm. There's nothing wrong with value-oriented discipline, like not paying more than the value of the cash flows of the business of the future, like anchoring to fundamentals. But I think anchoring to the fundamentals in a way that doesn't allow you to see the future, doesn't allow you to see innovation, doesn't allow you to embrace technology, is a loser's proposition over the long run. So I'd say what I do at a high level is long-term value-oriented investing, but without being afraid of the new thing. So for example, our fund today, I'm holding healthcare companies, I'm holding energy companies, I'm holding beer companies. So a lot of traditional businesses, but I also hold a chunk of Bitcoin, right, in the fund. So the fund has Bitcoin, physical spot Bitcoin, some Bitcoin derivatives, and then traditional value equities in healthcare, staples, energy, et cetera. And so I think blending those together over 10, 20 years is going to give exceptional risk-adjusted return, of course, with full liquidity. I do private investing, Rajeev. I will say that. I've done a number of maybe 10, 15 private deals. One of them, I led the seed round, and they recently raised 20 million at a $100 million valuation with Franklin Templeton, one of the largest asset managers in that deal. So I've done the whole seed stage, the Series A, Series B. I've done the IPO phase. And I think one of my edges in investing is being able to do the full life cycle. I understand how to do a seed stage term sheet and a safe, right? The right parameters to help the founding team get leverage out of the investors and also not put themselves in a bad position when they get to the Series A, Series B, put terms in there that end up basically poisoning those future term sheets, right? And as well as helping the team prioritize at the very early stage strategy, hiring, capital raising, basically the 3 or 4 fundamentals that drive results for seed stage companies, all the way up to post IPO, right? Governance and activist investing in the public markets. And I think as I look around the investment marketplace today, I see a lot of seed stage investors. I see a lot of late stage venture and private equity investors. And then I see a lot of public only investors. I don't see a lot of investors who are just as comfortable leading a seed stage term sheet as they are taking a company public or joining the board as an activist, right? Later on, if the company is starting to fail and needs to be turned around. So I like to think that that's part of the edge here, is being able to understand value creation across the entire life cycle from seed to post IPO, and then applying that primarily to liquid investments looking forward. So let me pause there because I think I gave probably a good 10, 15-minute overview of how I think about investing and what I think the biggest opportunities are right now.
Fantastic. I think I've got so much of food that, I think we're going to be sitting and talking for the next 2-3 hours, but we'll try and keep it brief. So let me start off with the first point, right? So you mentioned that you're able to sort of straddle both the seed, very early stage, to public market investing, right? And it seems to me there's a dichotomy there, right? So in late stage, of course, there's a lot more of numbers, there are Excels, there are performance charts, there are metrics. There are numbers that talk to you, right? Whatever, revenue curves, profit curves, inventory curves, debt, equity, burdens, what has the company done, employees, cost of employees, scalability costs, everything is there. You've got a lot more data available to you as you get after the CDC, DEF, right? That's sort of where these things start to build up, right? Whereas in the early stage, you literally have nothing to go on. There is maybe a wafer thin Excel, and this is all in the mind of the founder, right? There's really nothing out there because a bloke is coming to you with maybe $500,000 revenue, right? There's nothing really to talk about there, right? And of course, there's a lot more of a punt on the future per se. How are you able to straddle these two entirely different worlds? I'm very curious to hear how you're able to make a success story out of both of these worlds. Can you give me a little bit more sense of how that works?
Yeah, it's an interesting point. I think when you distill it down, though, and you try to make this really simple, seed stage investing is about a read on people, right? And it's about courage, right? Public investing is a lot more about data, right? Like, what does the data say about the quality and the sustainability of this moat? What does the data say about the efficiency of this management team and taking investor capital and turning it into profits? But what I found, Rajeev, is that at the early stages, a lot of founders would benefit from that type of public mindset and thinking about the business from the very beginning and then reverse engineering some of those decisions from those early stages with the end in mind. But flip it around. I see a lot of public investors and board members with no courage, with no heart, with no read. It's almost like they're missing that gear. And so there are times where you sit in a boardroom with experienced public board members, and it's not that they're not great people, but they're so data driven that they sometimes miss the very, very obvious interpersonal things. They miss the character related issues that a seed stage investor has to know, because you're literally making a binary bet on this person. You're looking in that person's eyes and you're saying, do I believe that this person can win? Do I believe, like deep down in here, do I believe that this person is going to be a winner and that they're the right person to execute this business model. Of course, you start with, is it a big market, right? Because if it's not a big market, then none of those things matter. But assuming it's a big market, then the very next question is this the person that I want to back in this market, right? Do I want to take Travis Kalanick or the founder of Lyft, right, in rideshare? And so I don't think it's necessarily mutually exclusive, right? You could think of it as binary, you could think of it as two ends of the spectrum, but I actually think they're blended. I think the capabilities and skills of a seed stage investor can be quite valuable in a public corporate boardroom. And I think the instincts, right, of a seed stage investor can be valuable, but also that the data-driven sophistication of that public market investor can be valuable when you just have 3 or 4 guys at a seed stage company sitting around who there's nobody in the room who's never sat on a public board. There's nobody there who's ever done $1 billion acquisition. There's nobody there who's ever, right, seen they don't really know how even the bigger companies that are potentially going to buy them think about their company. Whereas if you've sat on both sides of the table, you've both been acquired several times, but you've also acquired other people several times. You understand the mindset across the spectrum. And that can be valuable because, as you know, Rajeev, sometimes a good exit is you invest at the Series A and it sells immediately for 200 million cash, right? And you were in at 30 million or 50 million pre. As long as it's quick, that's a nice IRR. But you need to know how to do that acquisition, make sure you have enough leverage to get the acquisition closed, because there's a lot of term sheets that never end up in a closing, as you know. And so a good board can help a founder work through that. So that's kind of how I would frame it. I don't know if that's necessarily the answer you're looking for, but I don't think they're binary and I don't think they're mutually exclusive.
I love the answer because see, life is all about finding these non-linear pathways to succeed, and nothing succeeds like success. If you've got a successful portfolio, then that speaks to more than anything else. But I have another curious question in the same light. Look, early stage is all about Markowitz, right? So you remember the portfolio theory that we've studied in college, right? So it's essentially about making sure that you're placing small bets, right? And not more than 5 to 7% of your entire fund portfolio in one company at any point in time. Get about 20, 25 such companies. Assume that there is going to be maybe a 25, 30, 40% sort of a blow off rate, as it were. Some of these guys are going to fall by the wayside, and the rest that's left, you sort of, you need to get about 15, 20, 25% hits, really, right? That sort of takes care of the entire portfolio, right? Whereas I would have thought in the late stage, that propensity or the ability to lose money becomes a lot lesser, right? Because the check sizes are larger, the number of companies that you can invest in becomes smaller, and hence that ability to tolerate any rejiggings of valuation, sort of goes down dramatically, right? Don't you think that sort of sets up a very palpably different behavioral pattern between the late stage investing and early stage investing?
I do. Yeah. So, I mean, as a public liquid investor, I'm much more concentrated, right? I think my largest position right now is 40% of the fund, and collectively, like, you can put a whole category of idea being around like 60 to 70%, which is pretty concentrated. But I believe, based on my analysis over the last 5 years, that the space that I'm investing in is pretty de-risked at this point, right? Because I view Bitcoin as being like the internet of money. You can shut down individual internet companies, but you can't kill the internet. China tried to kill the internet. They shut down your ability to use Facebook and Google within China, but they can't kill the internet because the internet's too decentralized. And in a like way, you can kill a Bitcoin company. You can kill Binance. You can kill Coinbase, but you can't kill Bitcoin itself because it lives on this decentralized network of nodes and it's powered by this decentralized group of miners. And so with that context, like, it's sort of like investing in Bitcoin now is sort of like, it's even better than investing in a public company with a lot of revenue, because even a really good public company can go to zero if the business model changes suddenly, right? Or if all of a sudden there's new competition, or right, over 20-year periods, a lot of tech sectors turn over and the leaders become the laggards. But Bitcoin, again, is just more like the internet. It's just a binary thing. Like, if people like and value the internet, then the value of the internet goes up. The value of internet companies go up. If people use Bitcoin, which they are all over the world every day, then the value should go up. So with that in mind, I believe you should be sizing up and being more concentrated in areas like that, where you've done enough work over enough time to realize it's de-risk. There's no way to de-risk 3 guys in a garage. Even if you like them, even if they're smart, there's no way to make sure that that's not a zero outcome. And so you should expect zero outcomes in venture investing. It's just part of the math. But if you're doing public and liquid and later stage investing correctly, it's possible to not take too many zeros at all, if any, right? Because you should be operating with a margin of safety. You should be buying businesses with a lot of revenue, a lot of products, some diversification, customer diversification, geographic diversification, product diversification. And so you're not buying one idea and one group of three guys in a garage. You're buying a business that actually could almost run itself, and you could put a different management team in and they could run it, right? And so I do think about those things being very differently. And I think, for it to generate exceptional returns in non-venture asset classes, you do need to be more concentrated. You can't scatter bets everywhere. Otherwise, you will get the S&P return. You will get the index fund return if you own everything. And so the closer you get to basically indexing to everything, the more average, in a sense, your returns will be. And so, that's the hard part of liquid investing, is because you have to concentrate, and to be very, very successful, you have to concentrate away in any given period from consensus views, right? So you have to be long the internet in 2002 when everybody hates it. You've got to be long Bitcoin in 2022, 2023 when everybody hates it, right? And then you've got to be willing to hold those ideas for 10, 15, 20 years, and you need to be able to hold them in size, right? It's one thing to say you bought 5 Amazon shares in 2002, 2003. It's a much bigger thing to say you bought 5 million Amazon shares. If you bought 5 million Amazon shares, literally by 2013, you knew you had made it, and by 2023, you're one of the wealthiest people in your city or your state, right? In the U.S. So but that's what makes investing hard. The other thing, Rajeev, I'll tell you, this is something that I've been thinking about a lot that applies to us. You don't have to mark to market every day. That's just a fact, right? As a venture investor, you marked the last round of financing, and when you report your returns to your investors, you report it as of the last thing. So in 2022, a lot of things in the public markets, the comps, the bigger comps to all of these private venture deals, they got marked down 20, 30, 50, 60, Carvana, 90%, Netflix and Facebook were down 60+% peak to trough from one point. But venture investors, many of them, if there was no fundraising in that window, never marked down those investments because maybe they raised a lot of cash in 2020. I encouraged all my companies in 2020 and 2021 to raise. Eaglebrook raised the biggest round in the fall of 2021. And that was at my push. I was pushing the CEO saying, take advantage of this environment of high liquidity, high valuations, et cetera. But on the other side of the coin, with what I do now, I get mark to market every day, every hour, every minute. In fact, I was just checking my P&L 5 minutes before I joined this call to see where I was going to finish up the day. And so one of the challenges with liquid investing is that you're getting that instant feedback all the time. And the market has a habit of convincing you that you're wrong in the short term, even if you're right in the long term, right? So you buy, hypothetically, go back to 2002, you buy 100,000 shares of Amazon at $12. And if the market takes it from 12 to 8, that's pretty painful. 12 to 6, you might say, you know what? I lost half my money. I'm done. I was wrong. Of course, over the next 10 years, because e-commerce and because the internet was so explosive in its growth, and Amazon was one of the best run companies with the best strategy in some of the biggest categories, of course it outperformed everything, right? It was like a 30 to 50% compounder, sort of like Tesla, over the last 10, 15 years, right? Tesla kind of had a very similar trajectory, and maybe that's done, maybe it's not, I don't know. But it's hard to hold those things when you're mark to market every day. It's much easier to hold them when there's no liquidity, because literally the market says, you know what, Rajeev, you can't sell right now, and you're like, I don't know if that's good or bad, but it turns out for most people, when you look back 5 or 10 years, a lot of the value in investing is just not selling, just holding things that are already good ideas long enough for them to actually, achieve their potential.
Brilliant. I just love that answer. Thank you so much, Mike. Let's switch gears a little bit. So you started to talk about 2000s, right? And I think it's a very interesting analogy at this point in time, right? So in terms of, the 2002, when internet went out of favor or nobody was wanting to talk, it's sort of where the crypto world is right now, right? You don't want to talk about crypto. There's not too much. So I just want to, so if we were to compare these two parallels, if you were to compare that time with today, what are the kind of compare and the contrast that you would actually do, right? And remember, I'm also asking this from the point of context of the fact that you're in the West Coast, you're a Stanford graduate, so you sort of sit at the heart of the Silicon Valley ecosystem per se. And of course, the rest of the world is sort of looking at Silicon Valley, has been looking at Silicon Valley for the last 30 years for tech, right? Every single big company came out of there. Given that, what are you seeing? And maybe you can get a little bit more into what are the Googles and the Amazons of the future? And what are the Ciscos and Microsofts of the future? I mean, in the context of the next 15 years, you're not going to see, the stock price rise. In your opinion, what's sort of happening there?
Yeah. So, I mean, it's a pretty broad collection of things that you could talk about here. And yes, being at Stanford in the late 90s, early 2000s was a pretty great time to see the blow up of the internet bubble, but then also the sort of resurgence and kind of the second and third generation of internet companies when we sort of went from Web 1 to Web 2 to now Web 3, right? With crypto and decentralized networks. Of course, there's going to be an AI overlay of all of this. AI, just like the internet, is going to be infused into every product, every service, if it's going to be competitive in the future, right? Because there's just so many things that you could optimize if you're using an AI instead of a human view, because humans are much more fallible with data. They're much more fallible with extrapolating that data and making inferences from it. I'm not saying AI is perfect by any means. Of course, it has a long way to go, but it's very clear when you look out 20 years, AI is going to replace a lot of human brain power during that period, and you have to figure out how to position yourself. But within crypto, I kind of think it's Bitcoin and everything else, right? I think the one idea that to me has merit no matter what happens in the world and will grow over the next 20 years is just Bitcoin itself. Like if you just do one thing right as a so-called crypto investor, somebody who's interested in crypto, it's just to hold Bitcoin. That's a long discussion, maybe thousands of hours for some people to really understand why that's the case. But I have put in the 5, 10, 20,000 hours over the last 5 to 7 years to understand the space. When you move beyond Bitcoin, Ethereum is also probably a digital commodity, but it's a lot more like the Amazon web services. It's a lot more like a services layer on top of a decentralized network that allows you to build other applications on top of it. And of course, Bitcoin's now going to have that with inscriptions and ordinals. So people are now using the data layer of the block space to publish stuff onto the Bitcoin blockchain as well. So it's not going to be exclusive to Ethereum. But certainly if you're running certain types of programs, certain types of financial programs that are automated, like automated lending, automated staking, automated trading, like what Uniswap does, Ethereum is going to be an interesting layer. So I think, again, at the protocol layer, and this is what makes crypto investing so challenging to compare and contrast 2002 to 2023, is that in 2002, 2003, you couldn't invest in HTTP. You couldn't invest in the protocol layer itself. Like you couldn't own, if somebody had monetized HTTP as a protocol and said, I'm going to create 10 billion HTTP tokens and every single one's going to have 0.0001 cent value. And to load a web page using this protocol, you have to provision as a utility token, this HTTP token to make this page load. That could have been a model back then, but of course you would have needed the internet to distribute it. So the internet rails weren't really built yet. This was the building of the internet rails at that time, using open source protocols like HTTP and other protocols that made the internet really work, like SMTP for email, et cetera. So if you think of Bitcoin as that today, what's different is Bitcoin's monetizing now. So when you buy Bitcoin, you're not just like speculating on the future value of this sort of digital money. What you're buying is a stake in the network, in the protocol layer, such that if the entire network and the entire protocol becomes more valuable, it will self-monetize, and that will be reflected in that price. So it's a very different type of way of thinking about the world than most company investors think about the world, right? And again, to invest in the internet back in 2002, you had to buy internet stocks, right? You had to buy stocks in general. You had to buy companies. To invest in Bitcoin, you can buy the protocol layer itself, or you can buy companies. And so in terms of, again, protocol is a no-brainer. And I think that's the only no-brainer investment in all of crypto, having studied it for 5 to 7 years now. But if you want to do internet, if you want to do Bitcoin companies too, the infrastructure layer is kind of the one that is a no-brainer, right? Because essentially, the best analogy again is Equinix. The ticker is EQIX. You go back to 2002, 2003, it was a $3 stock. I think it's at 750 now. So it's been like a 200, 300x off the lows over the last 20 years or so. And it hit those highs, by the way, in like 2017, 18, 19, I want to say. So like, it took 15 to 17 years to do it. But basically Equinix in 2003, there's just a company that had land, buildings, data centers, and they had chips. And they were just basically providing the bandwidth that powers the internet in a sense, right? That allows the entire data transference to happen. And Bitcoin miners are the same thing. They call them miners, but think of them just as Bitcoin data center operators. They're literally structured exactly the same way as Equinix. They buy land, they build 30, 40-year long-lived buildings, they plug in specialized ASIC chips from China, and they basically provide computing power to the network, and the network pays them in the form of fees. So the ones that are selling Bitcoin every day, they're just turning their Bitcoin into dollars or euros or yen or whatever. And so they're just an infrastructure business like Equinix. They're just happen to be using Bitcoin as the accounting method, right? Because they mine Bitcoin. And so as the value of Bitcoin goes up, you get a lot of operating leverage on that business. Because again, you're still doing the same thing. Your power cost is still the same. Your rent for your building, if you don't own the building, is still the same. The cost of your chips is still the same, but now the value of the Bitcoin you've mined has gone up, right? And so what happens every cycle is that they're like gold miners and silver miners, but gold and silver don't have the parabolic price moves that Bitcoin does, in part, again, because Bitcoin's a digital asset, and also because the supply is completely constrained algorithmically. Gold, silver, and other metals and commodities like that can be mined more when the price goes up. And so that increase in supply actually decreases demand. Part of why you get these parabolic spikes with Bitcoin that you don't see in other commodities is that the supply is constrained by the code. And so no matter how much demand there is for people to buy more Bitcoin, there's not going to be any additional supply. That supply curve asymptotically approaches zero. So I think high level, Rajeev, I think Bitcoin, if you want to sprinkle in a little bit of Ethereum to have exposure to kind of the AWS of crypto, that's fine. But I would also be looking at Bitcoin infrastructure companies like big data center providers. Some of the ones I like are like Cypher, Bitfarms, Iris Energy, Riot, et cetera.
Excellent. So those are your Amazons of the going forward future. Excellent. Let me switch gears a little bit. I mean, I'm starting to see some kind of a dichotomy in the market right now. On the one hand, you got these edgy companies, right? NVIDIA going to $1 trillion because of the AI revolution. 100 million users within a month and a half or so for OpenAI. The fastest growth of any network, that kind of thing, right? And you got wave after wave of it's almost impossible to catch up with what's happening in AI right now, very simply because of the fact that every day it brings so much more information about it, right? So that's something that's happening. On the other hand, the traditional guys like oil, gas, copper, aluminum, iron and steel are not out of favor. They're coming back into favor owing to the entire storyline around inflation and the shortage of, supply and, lack of investment how are you, I mean, isn't it a little strange that these two extreme ends of the economy almost, is like the left tail and the right tail are sort of rushing ahead, whereas the rest of the economy sort of seems to be flattening out? What do you think about what's happening here?
There's so many dichotomies like this in the market right now. And this dematerializing of the physical world, right, is the way that I think about it, because so much of the growth in the future is digital, right? It's deconstructing the physical world and putting it into the metaverse, basically, right? Like creating this alternative reality that doesn't require you to physically be somewhere. And I think that's a great vision, and that idea will win over time, but not at the exclusion completely of developing the physical world. It turns out that to run the internet, to run the Bitcoin network, to run AI requires a tremendous amount of computing power. That computing power requires a tremendous amount of raw power, whether that's coming from nuclear, wind, solar, natural gas, et cetera. And so you can only dematerialize the world so much before you hit the outer edges of what is basically the limits of physics. the limits of our physical reality. You can dream up a scenario, but you actually need to have the power, the sustainable, clean, efficient, and potentially and eventually cheap power. It has to be ubiquitous, right? This is why we use washing machines and we don't wash by hand. This is why we drive Teslas and we don't take a donkey to work, right? All of these things, human societies require more energy. They require more things in the physical world, essentially to execute. And the internet and the digital realm and the metaverse and AI and all these things are not immune. That's what a lot of people don't realize. They're sitting with their metaverse helmet in their room, running an air conditioning box. It's 100 degrees in Nevada, that's driven off of natural gas or driven off of solar, right? And so, same thing when you plug in your Tesla, you may actually be using coal-fired power in certain parts of the U.S. So you think you're green, but you're actually using the dirtiest power possible. And people aren't able to make that leap because it turns out that most people are not that aware of the physical world. Most people are not that aware of what makes a car actually work. How does a natural gas or nuclear facility actually work? What are the downsides of winds and solar? What are the upsides of winds and solar? What are the energy economics that drive those decisions? Like, how do you create a sustainable grid over time, et cetera? And so I think one of the challenges in investing right now is a lot of people don't understand any of those base layer ideas, but they want to jump straight to AI and metaverse. And I think that puts you at a huge disadvantage versus people who can see both sides, both the material world, of the world of physics and universal laws, but also the digital world and AI and computing power and the cloud and dematerializing of the physical world. I think that dichotomy is super important, and it's showing up in income inequality, right? It's showing up in gaps between the best performing companies and the worst performing companies. Turns out if you invest in new technologies and you're right, you will vastly outperform everybody else, and your shareholders will be vastly wealthier. Your management team, if you're Elon Musk, you'll be the richest person in the world if you're right about these ideas. And so that's the real dichotomy is between the winners and the losers across time. And if you really believe we have a free market globally, and I believe we do collectively globally, even though China might not be a free market, even though the US keeps interjecting in our capital markets anytime there's a problem and applying more fiscal stimulus and printing more money and raising the debt ceiling and all these games we play with the monetary system to juice things. I do believe at a global level, it's still a free market. Essentially, the best ideas win, and they win the lion's share of the market opportunity in whatever category they're playing in. And the really big ideas start to eat other categories. Software, as Mark Andreessen said, eats the world. AI is going to eat pretty much every category. The internet started to eat up a bunch of physical world categories. That's all true. And that's the reason why you own Amazon, Apple, Netflix, NVIDIA, et cetera. But it's also true that you need energy and power, and it needs to be sustainable, right? And that's not the only thing, right? But you need infrastructure to support all that. And I think when you understand both sides of those, it makes you a better investor because you can see when the digital world is overvalued, and you can see when the digital world's undervalued, and vice versa, right? The material world got too cheap. Basically, in 2020, natural gas companies were trading at like 30% of their proven reserves, right? They, of course, the best natural gas companies in the US went up 20, 30x off the bottom, Antero, Range, et cetera, right? These companies, EQT, the biggest natural gas producer in the US, like they were trading like they were going to zero, but people forgot, even though the digital world was hot, that you still need power to power the digital world. So.
Interesting. Switching gears to venture capital back again. So there is all this talk of the funding winter, and I think the logic seems to be sort of driven by the fact that if you got $1, when 3 years ago, the cost of the dollar was literally zero because the T-bill was at zero literally, and hence pretty much every other asset class sort of reprice itself along the lines of the bond market, whatever the T-bill, right? So zero became mortgage became 2.5, high yields became 5, and you know what I mean, right? So venture capital, private equity started to settle at 12, 13. Once this goes to 5.5, so everything else sort of gets repriced, and now it's 17, 18, 19. That's at the extreme end of the spectrum per se, and that's sort of starting to dry up the funds on the extremes because obviously the pension funds are now able to sort of sustain themselves at 7 with very safe instruments instead of going to the edgy parts, right? So there is a drying up stuff there. Do you see this funding winter sort of continuing for a while, given that we are likely to stay with this kind of interest rates and other things in the near foreseeable future? Where do you see the storyline panning out? And the reason I ask this is also because, Mike, a lot of our, future is riding on the fact that there is continual funding being given to these kinds of, edgy things, which are exponential, right? AI, crypto, Web3, these kinds of spaces, right? So the money, the risk on needs to come back and stuff needs to continue to happen for them. So I'm asking in that context.
Yeah, I think you got to bifurcate your brain again on valuation versus potential, right? And I kind of fashioned myself more as an Austrian economist than a Keynesian, right? And so I tend to like fiscal rigor, right? Spending less than you make, positive cash flow, reasonable expectations and multiples, et cetera, right? And so, I think a period of prolonged ZIRP, zero interest rate policy, zero to low interest rates, money printing, being accommodative of everything, essentially pushes everybody out on the risk curve and more capital chasing increasingly dumb ideas at really expensive prices. And so my gut bias is that anything that actually raises the hurdle rate for capital in society such that only the better ideas can still get funded is a net positive in the long run, because you have less waste. Because my view is that the very best ideas will get funded even if the cost of capital is 28%, right? Even if you raise interest rates to 20%, there would still be a dollar somewhere looking for the next AI deal. There still would be. But the only deals that would get funded are the very, very best not AI deals, not just three guys who literally last week had a popcorn machine and now they're in AI because AI is hot and that's an easy way to lower your cost of capital and to raise money easily. So I think a lot of entrepreneurs are playing games, right? And they're using low interest rates to not be really good at their business and to play games with funding rounds and raise too much money, right? They give certain terms away, but they can keep marking it up. And the investors are doing it too, by the way. Investors do inside party rounds so that they can keep marking the Series A to the B to the C to higher levels, even if the company hasn't really delivered. And that's a symptom of this loose money environment. So I would turn around on you and say, I actually think rates could go up more. And it won't actually hurt the best parts of the innovation economy, the type of entrepreneurs and companies you invest in, the ones that have true fundamental value in what they're building, who take the time to construct a product that customers really want, that wow their customers, that the customers can't use anything else because they deliver such a great product or service. Those entrepreneurs aren't going to have a problem at 5 or 6 or 7% interest rate. In fact, they're going to find there are fewer clowns and pretenders and jokers in the market muddying the waters and going to their customers and saying, we can provide a better service at a lower price, even though they're lying, they can't do it. They use cheap VC money to basically fund a product that's not sustainable. And that undercuts the good companies who should be able to charge full price. If the right price for your surface for like an enterprise AI application is $1 million a year and some jokers raise $20 million because capital is cheap and they start charging 500,000 or 300,000, some of your customers might go to that other firm, even if the product isn't as good. And those entrepreneurs maybe aren't as good at executing. And that's what happens in a low interest rate, zero interest rate environment. Everybody has money, even the least skilled people in the economy, even the worst ideas get funded, and it creates a lot of noise in the market. So I'd argue 5%, 6%, this is a healthy rate. This is the rate you want to see as a long-term investor, because you want to only invest in companies that can survive 5, 6, 7% rates. If a company needs zero rates to be viable, then they're not a viable company. They need to change their business model. They need to change their pricing. They need to change their product, but they don't need interest rates to go back down. All that said, Rajeev, it is very likely because of pressures in the US to basically continue to provide a robust social safety net and to fund all of the programs that need to be funded here, that there's just going to be a continued increase in the debt here. There's going to be an continued increase in the dilution of the monetary supply in terms of supply issuance. There's going to be more money in the economy. And it's possible that rates come down if there's any sort of hiccup over the next 3, 6, 9, 12 months in the macro economy in the US. So if unemployment starts to go up too much, they will lower the rates. But my argument would be, if I was the Federal Reserve Chair, I'd keep raising them. And I know that sounds, some people would say, oh, you're so aggressive, or what are you trying to do? Take down the innovation economy. And again, my argument is that that's actually healthy for the innovation economy, because the very best companies in each category won't care. It literally won't have any impact on them. It only hurts the less viable companies that really honestly need to be reorganized now, because otherwise they become zombie companies and they continue to hire engineers for another 3 years. Those engineers could have gone to situations that were going to be winning companies, but instead they stayed at the dying zombie company that was overfunded, right? And was able to stay alive even though they can't raise any more money.
I love the idea of, I mean, I think it's a great answer. I love the idea of this dollar rate as being a hurdle to dumb ideas, sort of making it through the, market gate almost, as it were. And I think it's a, I love it. I think it makes eminent sense. Let's switch to climate change now, Mike. We've been hearing quite a bit about this space, this arguably more and more interest across the planet on this. The Europeans are, I mean, I'm sitting in London right now, and everywhere you see, it's all about climate change. People are talking about it everywhere. Europe clearly is up there. America is out there. Most countries, Chinese, et cetera, right? So, and yet in the last 1.5 years, we've actually seen less investment going into climate change startups per se. Right. So, I mean, there seems to be a little bit of a dichotomy here, right? So what do you think is happening in this? I mean, do you see this space at all? Are you following this? What do you sense is happening here?
I mean, the Bitcoin infrastructure companies that I mentioned earlier are some of the biggest players now in leading the grid into more renewables, because a lot of what these large scale Bitcoin data center companies are doing is building facilities in the middle of nowhere next to stranded wind and solar and hydropower in a lot of cases, right? So this is solar power or wind power in the panhandle of Texas, where there's something like 20 gigawatts of excess power. It's a huge amount of excess renewables capacity, but there's no transportation and to get it all the way down to the load centers in the south. And so a lot of that power is essentially wasted. So I would argue the biggest opportunities in climate change broadly are right in front of our nose right now. They're just not necessarily called climate change, right? So I think you can, again, bifurcate some nuance here. You can say that climate change is real and it's an indisputable fact. I would say that I think all the data points to that. I think the incidences of natural disasters, the heat waves, the drought, the hurricanes, et cetera, like they're all indicative of some sort of change in climate. The question is, A, what's driving it? And I think most people would say that human intervention has some role in that. But also B, like what's the right way to address it? And I think what I'm seeing is people using that, they're carrying the flag of climate change, but then they're doing all the wrong things, right? So shutting down nuclear facilities. Nuclear is one of the most energy dense sources of energy that you can get, right? Anywhere on the planet. And it turns out the more nuclear you have, the less energy you have to create with emissions, right? The less dirty power essentially you have to continue to operate. But Europe is shutting down nuclear power plants. And so they're creating an energy crisis in the future. They're going to say it's for the betterment of civilization, but they're actually creating an energy crisis that's going to cause them to use more coal and more natural gas indefinitely. One of the reasons why I'm still an investor in natural gas pipelines, because even though I think it's a transition fuel, I think it'll be around for 20, 30, 40, 50 years because of how many dumb decisions policymakers are making globally and decision makers are making globally. So, I think the challenge here is like it becomes so political that it gets into a yelling match about whether you're trying to shut down the coal plant and put people out of work. And are you a Republican? Are you a Democrat? Does this make you a liberal? Does this make you conservative? But if you just think deeply about the issue itself, it's clear that climate change is real. It's clear that building renewable actually creates jobs. And it actually is good for the economy. So Republicans and conservatives can get behind that. And those opportunities, they're just sitting there right now to be executed upon. So I don't think that like lack of funding for climate change startups is necessarily a leading indicator for that, because I don't think climate change startups necessarily are going to be the driver of large scale energy use over the next 3 years. And over the next 3 years, that's the only thing that could change the actual climate change trajectory. Forget about the money-making opportunities and the PR and the narrative and the story, but let's just look at the data. Like you're not going to move the needle on climate change in the next 3 years unless you control large-scale energy infrastructure and you control how much meat production happens, right? And you control all of these things that are sort of like not necessarily controllable anyway. So I think over the next 5-10 years, there's going to be a lot of advancements. I think electric vehicles, electric charging stations, all kinds of advancements that are happening with alternative meats, right? Things that are happening with large-scale energy infrastructure and renewables, like getting wind and solar to a productive place where it can be used. And then of course, just things like liquefying natural gas from places where there's an overabundance, like the middle of the US, and then sending it to Europe and Asia, maybe where there's less natural gas as a bridge. But again, I think that the biggest issue is that people are making poor policy decisions globally that are not really backed by the data, because I think people get wound up in the politics of it rather than trying to figure out what's actually going to move the needle.
Thank you. We spoke about AI, so I think I want to return back to AI right now, but I've got a couple of very pointed questions here. One is really that, you remember the Google memo, the leaked Google memo, which basically said Google is going to lose. OpenAI is going to lose because OpenAI and ChatGPT are not open. And actually, the world is going to be around the so-called open source LLMs, large language models, right? So that's one part, right? And in parallel, there is this big movement by folks like Elon Musk and other folks who seem to be wanting to sort of cosset the world against AI. But it seems to me that, they want to cosset themselves against the advent of new AI, which could sort of come and eat them around. So it's sort of like protect us, in the guise of protecting the world kind of a thing. What do you think is happening? Obviously, I don't want to get into it's life-changing. Those things are very clearly articulated. And I think everybody is out there, if you've used ChatGPT, you sort of know how life-changing that can be. But what do you think is happening in the context of these two things? Where do you think the future is headed in AI?
Yeah, so I'm coming around to the idea that AI is dangerous enough that it does require some hard conversations as a society. And I think, like Sam Altman would even say that, right? Like this can be used as a weapon on some level, and it could be quite dangerous. So understanding the implications of it, probably more important than just like the understanding of the basic utility of the internet in 1995, right, or 1990. Like, yeah, more people will use email to send letters to themselves, and that will disrupt the postal service, right? But AI can disrupt everything. It could potentially destroy the planet, is sort of the view that I'm coming around to. And so if that's the case, then it would make sense that there are going to be factions of people that are anti-AI, or just maybe not anti-AI, but anti-open, allowing AI to sort of proliferate openly without any sort of controls whatsoever on its usage. I don't have a strong stance yet on that, because I don't know enough to know, exactly what people are advocating for. But I think this sort of picket lines on both sides type of thing that you're going to probably see, and it's multidimensional. So there may be 3, 4, 5 major factions who have slightly different views on globally what should happen here. But I'll be watching it closely, because it's clearly a very important thing for the future of humanity.
But it seems to be a slightly disingenuous argument, doesn't it, Mike? So it's almost like, look, guns are dangerous, but we are the only ones that understand guns right now. So we should be allowed to use it. That is Google and Elon Musk and Tesla and other guys. And the rest of the world has to have regulation to, trying to use it. That sort of is the logic that's sort of being, put out there. Yes, I agree that gun technology is dangerous, but it's also that case could be made for every single technology, benefit that has happened in the world out there, right? Including nuclear, pretty much think about everything, So, yeah. Don't you think it's a little of much ado about nothing? Yeah. And it seems to be sort of, vested interest trying to guard their gates before all hell breaks loose and they lose their value, as it were. Goes back to the leaked Google memo, which basically says, look, Google will have no value in the next 5 years if this continues to happen. Don't you think that could be the skeptical point of view of, sort of this world?
Yeah, but I agree with everything you just said, in the sense that if it's somebody wants to set up a system where they have unique ability to leverage new technology and other people don't, I think that's clearly wrong, right? And if you look at history, anytime a new weapon like a cannon or a gun with gunpowder is created, it completely changed the rules of engagement. It completely changed the essentially cost of exercising violence and the cost of defending yourself against violence, right? And so I think AI is a new dimension in that model, where AI increases in some ways the cost of attacking and also decreases in other ways, and vice versa on defending. And so I think, look, it's a new thing. I don't think any policy that tries to anoint certain people as the leader or anoint certain people as the people who can use it is going to work. But I can come around to the idea that general society-wide conversations around this, so that everybody's on the same page and understanding of what people are doing here, it could be quite helpful, right? Because like in the areas of like deep fakes, for example, like people can essentially create fake versions of you doing something, fake videos now, fake you talking, right? And so without some understanding, I mean, that's a weapon, right? Because you could destroy somebody's life by sending a bad video of you to somebody at the wrong time and have them believe it's real, right? And we're already hearing that, like a hostage situation where someone fakes someone's daughter's voice and is able to call in a hostage situation to try to extort somebody for millions of dollars using AI and deepfakes, right? And so I think just understanding that, again, just like in the internet, there were fake Nigerian princes, and in crypto there are a lot of hackers and scammers that just want to take your crypto. There's always downsides, but I think the difference between crypto and the internet and AI is that it's possible that AI at some point could actually destroy the planet on its own with no human intervention. And those other things, those other historical technology, like a gun is only valuable in your hand. It doesn't have a brain. So if I put a gun down over there, it's not going to kill anyone. If there's no way in physics for that to happen, right? If the safety's on and right. But AI can at some point pick up, AI is a gun that can pick itself up, walk across the room and shoot on some level, right? And if you understand it with that sort of mindset, then certainly it would raise some questions about some sort of guardrails, not in a way that's prevents one company from being competitive versus another, but that sort of protects the broader general society. Like for the same reason we don't allow people in my neighborhood to keep tigers legally, or we don't allow them to keep nuclear weapons in a briefcase in their garage. Like that's illegal to do that. I think it's okay to say, hey, like AI is good and it has a broad generalized use, but if you use it for these things, we generally think that's not good, right? Like because simply calling it out for what isn't, saying using deep fakes to extort people is bad. At least now you have some sort of standard that everybody agrees on.
Fantastic. I think, we have reached the hour, Mike, and it looks like it's sort of, that zooms by. So really enjoyable conversation. Great points of view. And at this point in time, let me just call a halt to it. I'm sure we want to get. Have you been to India, Mike? I mean,
Yes.
You have been to. So, okay.
Yeah.
So we should get you more frequently over to India so that you can talk to us and, give us a little bit more of this kind of insight. So look forward to further such conversations. Thank you so much.
All right. Thank you, Rajeev.